Welcome back to Getting Down to Business. We are joined today with the founder of the Hindley Burgmaier Group and co-founder of Burgmaier and Associates, Mr. Eric Burgmaier, certified public accountant, certified valuation analyst, and Eric is going to be sharing some year-end tax strategies for 2024. Now, hopefully you're already working with a good accountant, but if you're not, these are going to be some ways to make sure that you're not overpaying on your taxes. We're going to be examining a few different strategies, keeping in mind that it's better to be employing strategies throughout the year rather than trying to frantically apply tactics at the end of the year. So before we get started, go ahead and hit the subscribe button, ring the notification bell so you never miss an episode. You can also visit our Burgmaier and Associates website for all of your accounting needs, or hindleyburgmeiergroup.com for the dental practice transition and valuation resources. All right, let's go ahead and begin the episode right now.
I guess, just sort of an overview of your thoughts about, where are we headed, and what does that mean for the tax for tax implications and things like that.
I to keep politics to a minimum on this, but I don't particularly care what gets out there. People kind of know what my positions have been as they've seen me and my comments on LinkedIn. I'm very excited about the future now, especially over the next 5 to 10 years, for the small business owner. What I hope we see out of this incoming administration is what we saw the last time they were in position of leadership, and that is specifically lower taxes and lower regulation. And to the degree we continue to have a government that supports lower taxes and lower regulation, I believe we're going to continue to see our small businesses thrive. The challenges we face as small businesses is trying to compete and continue to move forward in an environment where local and federal governments pile on more regulation. It's hard enough to run a small business. It's hard enough to hire people. It's hard enough to offer competitive benefits. But to then continue to have ongoing and piled on more regulation continues to make it much more difficult for the small business. So I believe over the next couple of years, we're going to see a nice open runway for small businesses to continue to do even better now. And I suspect that the current tax code is going to continue into the next 5 to 10 years again, but even better, again, lower tax rates, allowing for more investment and small business owners to continue to deploy more free capital back into their business as opposed to giving it to an inefficient government.
What are some last minute tax saving strategies that could significantly reduce taxable income for 2024? Do you have like a top 5, or do you have like a few?
I always hate the last minute things because, it's like we should have a strategy that we're following along the way. Last minute to me is like, I'm reacting now, right? And I haven't been planning correctly. But if we want to kind of go to, gee whiz, maybe you're having a way, let's start with, I'm having a way better year than I expected. And suddenly that reward of all my hard work is coming in the last quarter. I didn't anticipate this. What can I do now to, let's say, minimize a tax burden? I mean, the government is still very generous with some of their depreciation, the depreciation methodologies available to us at the end of the year. Under Code Section 179, we can take a full deduction of certain equipment that's been acquired in this year. I don't like people to just go out and buy equipment to save money on taxes. It's certainly not a wise use of your money, because remember, any profit you have, somewhere between 65 to 75% of that is yours, and now you're sharing with the government 25 to 35%, depending upon what your tax rates are. So if you spend 100 to try and save 35,000, you spend 100,000 to save 35,000, 100,000 has gone out the door. Conversely, if you have 100,000 and you spend 35,000 or you pay 35,000 in tax, I'm not an advocate, of course, of just paying taxes. Obviously, you have to, but the alternative is to keep 65,000 to 70,000 of your money yourself, give the government their portion of that, and then you're still at a positive. So the idea of spending 100,000 on equipment just merely to avoid paying taxes or minimize your tax liability really doesn't make economic sense. However, if you are eyeing certain equipment, so I'm talking to one of my dental clients the other night, and they're coming into the end of the year and blessed with some high level of case acceptance, and they're going to be doing 3 or 4 massive full mouth reconstructions in the month of December, potentially doubling their income in that 1 month alone. And he was deciding whether or not he was going to purchase a new milling machine and or a couple of dental chairs. And said, well, if you're not expecting to have that kind of revenue going into next year, number one, but you still need that equipment, then maybe it's a great idea to buy that equipment now and get it installed before the end of the year. Take advantage of the high depreciation limits you can take on that equipment now. Because that makes a lot of sense, because you need the equipment, you want new equipment, and now you're going to have a banner year end. So let's mitigate some of that tax liability, knowing maybe next year you may not have those same kind of cases again. So this could be a great year to take advantage of that. So that's kind of like a quote unquote last minute strategy. I'd say the other big last minute strategy is, most all of my clients have some kind of retirement plan in place, whether it's a simple IRA or a SEP. Many don't have SEP, but or 401k or some kind of pension plan. Again, going into the end of the year, if the end of the year is looking like it's going to be much better than expected, or quite frankly, as good as what's been anticipated, making those year-end additional contributions to retirement plans offer the same benefits from a dollar for dollar reduction of net income like depreciation does. But I always say this instead, that this is money paid to your future self rather than to another company. So I would say really looking at what kind of retirement plan you have and what kind of retirement plan options you have to fund larger amounts maybe than you originally anticipated, or quite frankly, if you did and haven't done so, that would be another great option. A third option would be, if you do have children and they're children of working age, maybe you can put them to better use in the office in your small business, and pay them a little bit more coming into the end of the year than you anticipated. The standard deduction right now for a single individual is right around $14,000. Don't hold me to the exact dollar amount for 2024, but this is a great way to take money from I call it tax arbitrage, to take money from a much higher tax bracket and pay your children who, arguably speaking, if they're under that $14,000 of earned income in 2024, may not have to pay or file an income tax return at all, depending upon what state they're in. Most states will follow the federal law. So if you're paying them $14,000 or less and they have no other sources of income, it's a great way to move $14,000 from a parent, small business owner, high tax bracket to a child who would likely not otherwise pay income taxes, to get around $14,000 paid to them, and that escapes all income taxes. Again, kind of not necessarily last minute. This probably should have been a part of a full year planning, but
Yeah.
then you're being successful into the end of the year and you weren't thinking about this. Another great year-end option.
Oh, I didn't know that. So you're saying, if you have children, you can actually maybe not ideally writing them out a check at the end of the year for 14 grand, but over the course of the year, you're giving them, help so that at the end of the year you have, so let's just say that 14,000 that you've, given up to them, all that's tax deductible, huh?
Yeah, what I want to make sure you're thinking about when you're doing this is you really want to put your child to work. So, if you've got a
Sure.
6-year-old, it's awfully hard for them. It's awfully hard for you as a small business owner to justify. I mean, there could be some really creative ideas out there, far beyond my ability to comprehend, where a 6-year-old earns $14,000 in earned income, right? But if you have a 16-year-old and they're working in the business doing, maybe some more clerical work and some janitorial work and maybe some limited marketing, but depending upon whatever the business is, it may be much easier to pay a 16-year-old, $1,000 a month, $250 a week kind of thing for 8 to 10 hours of work, that you're actually, the whole objective here is not simply to take advantage of just abusing the law here, but actually try and put your child to work, have them earn some income, and now make them financially responsible for paying for like soccer camp and the other membership fees that they may have, rather than mom and dad paying for that. Sure, we're going to pay it regardless, or we probably would have paid it regardless, but instead put your child to work. You get a deduction in the business. You keep that income under $14,000. They don't have to file a tax return because it's going to be under the standard deduction for a single individual. And now you begin to teach them a little bit of financial discipline and say, okay, you now pay for volleyball camp. You now pay for your soccer equipment. You pay for this out of your earned money. So it's a nice way to get your child engaged in finance as well. So part of this process, again, with a child, and every kid ain't going to connect with this, but some will, is not only do I pay you, and then you become financially responsible for paying some of your bills, and you begin to appreciate what hard work is. The other benefit of doing this is having your child now fund a Roth IRA account. So you can really take this to a whole nother level, where as you're paying your child and you sit with them and set up a Roth IRA account, and now they become engaged in investing in their future retirement through a Roth. It's a brilliant way to help them really get a leg up on their future retirement, and again, have the basics of some intelligent conversation around investing and what that means, and what does it mean to do so via a Roth IRA account.
Yeah, that's so big. I mean, I just think about, I wish I'd had somebody, at 16 really sit down and talk to me about the importance of these different investment opportunities, through different accounts, and just the lack of financial literacy among the youth is not uncommon, unfortunately.
Yeah,
But
it's not taught at all in school, unfortunately. And I really think if you want to take advantage of, we kind of talked about this from like last minute. And again, I hate the idea of, oh, we're in December, what do we do? It's last minute. And then, wow, quickly pay your kids. This should not be pay your kids quickly at the end of the year because you can save money on taxes. The smart thing to do is pay your child throughout the year and have an intelligent conversation with your child on a monthly or quarterly basis about how they're spending that money and or investing that money and doing it the right way. And that's really the intention. While we're here at the end of the year, and this is a great opportunity to remind people again that if you haven't paid your child, do so. But more importantly, what you just discussed, Josh, is what you mentioned is like, begin to talk about what this means with your child. You're earning money. Now you're responsible for two things: paying some of your bills, as well as funding a Roth IRA that sets you up for lifelong success if you continue with this habit from a 16-year-old, 17-year-old, 18-year-old perspective. So
yes, and for the kid, the Roth IRA seems to make more sense because they're most likely not going to have a huge tax burden. So putting it into, say, a traditional IRA where they would already sort of save money for taxes,
that's right.
it's not necessary. They might as well just start doing the tax deferred earnings.
Yes, and that's a
Yeah.
brilliant point, Josh. If you were at a 0%, 10%, 12% tax bracket, you do Roth every day. Which means you pay the income tax and then you take after-tax dollars and contribute to a retirement account. If you happen to be at the other end, the high end of the spectrum, I still believe it's going to be beneficial for you to have a tax deferral method. So if you're in a 24 or 32 or 35% tax bracket, it still makes sense to defer money today in a tax privileged account like a 401k. I mean, if you're making that much money, you shouldn't even be thinking about a traditional IRA. It's likely you have way more options. But when you're at the high end of the tax brackets, it makes much more sense to contribute on a pre-tax basis. When we're talking about the child strategy, it makes way more sense to contribute to a Roth. One more important point, this does kind of become a end of year decision-making process, is whether or not you're eligible to pay your state income taxes through your pass-through entity. And I'll be really lucky if this video gets out to people in all 50 states. And I'm not an expert on all 50 states and whether or not they have this pass-through entity tax election. I would suspect by 2024, probably 40 states, if not all 50. Well, it wouldn't be all 50, but between 30 to 40 states have adopted some type of pass-through entity tax election strategy, which allows the small business owner that operates their business through a pass-through entity, and a pass-through entity is either a partnership filing a 1065 or an LLC filing an S-corp return, an 1120S, to pay the state income tax liability through the business, reducing their income ultimately, and then reducing their federal income tax obligation. And it's not beneficial for everybody because every state, I believe, is going to charge that pass-through entity tax at the state's highest tax bracket. It's a case-by-case situation, and I'm doing that calculation for all of my clients. And generally coming into November, well, quite frankly, by August, we kind of know whether or not they're a candidate. And if so, we're beginning to fund it in August. And really, when we get to December, we're just showing up what that tax payment needs to be. And I like to get that payment paid in by the end of the year to match the cash basis requirement where we're getting the deduction as they've paid the expense as we end the year. So the pass-through entity tax is another great year-end strategy for business owners.
Okay, great. And so you said that something like that, here in New Mexico that business owners can just do automatically? They don't have to apply for anything special to do that. It's just an option they can have?
Yes, that's right. It's
Okay.
it's an option they make. Let's just assume you had $200,000 of income prior to this tax. And so in the state of New Mexico, at roughly a 5.9% rate, or let's round up to 6 to make it easy math, that's a state income tax obligation of $12,000. So now that $200,000 only becomes $188,000 when we're calculating federal income taxes. And if you're at a 32% tax bracket, that's real savings on the state side. You're going to owe that tax regardless of whether or not you do this through the business or paying it personally. So that doesn't matter. What matters is whether or not you're going to be at a high enough tax bracket where you're going to pay at that higher rate and still benefit on the federal side. And I go through that calculation for my clients. And, if you're going to be at a 24 or, 32% tax bracket, believe me, it's beneficial for you to do this strategy.
Absolutely.
One of the other things that frustrates me at times is the idea of accelerating expenses and, maybe in addition, delaying, if you're on a cash basis and you're getting a bunch of checks in the last week of December, can I accelerate my expenses? Can I prepay my rent? Can I prepay my insurance? Can I prepay supplies? Can I buy some extra inventory and put that on the books at the end of the year? And if I have income that's, checks that are being mailed to me and I forget to check my mailbox in the last week of December, and then deposit all those checks in January. Can I do that? And say, of course you can do that. However, once you kind of make that a strategy in your, and you do that, you now set yourself up next year where you're scrambling to do it the following year. So you can benefit. I can be a quote unquote genius year one by saying, gee whiz, Eric, you really helped me mitigate my tax liability by making me prepay 3 months of rent, and prepaying some of my other insurances and prepaying some supplies. And then I brought in all these additional expenses in December, and I kind of slid some of those last deposits and pushed them into January. Wow, that really worked for me. Yeah, but now starting 2025, I kind of start myself in the hole, and the best I can do is kind of get square the next year with 12 months of expenses on rent, because if I prepaid 3 months, I'm going to go into next December and try and prepay 3 months again. It works year one. It's not a great strategy to continue. Sometimes when it benefits, I would say employ this strategy when you kind of want to take, again, call it a strategy, as opposed to tactics. But what I mean by that is strategic is kind of a multi-year plan versus being tactical, which is a month by month kind of thing. If you know in 2024, or conversely in 2025, that you're going to have an extraordinary year for whatever reason, and it's not repeatable, it's likely not repeatable. Employing a technique like this, where you're accelerating expenses and otherwise deferring revenue, may help. If it keeps you from getting into a 32% or staying into 32% tax bracket, because I do have clients that are blessed by having an extraordinary year because of a governmental contract that created $300,000 of net income, that they know this is a once every 3 or 4 year kind of event. Well, in that once in every 3 or 4 years, maybe deploying the strategy where you're accelerating expenses and deferring revenue in that particular year makes sense. But if you're always going to be around a steady Eddie, you're a dental practice and you're doing $1.1 to $1.2 million in revenue, and you're generating roughly the same kind of net income, this strategy may help in year one, but you put yourself in a bigger hole beginning in year two. Does that make sense?
Oh yeah, sure. Yep.
Yeah. So sometimes it works. And I think it's on a case by case basis where it may work. But a lot of times when I see a client having a really good year and we're coming into the end of the year and possibly thinking about that, I'll always ask, what do you think's going to happen next year? And they're like, no, we're on this path, man. We're just going to continue. We're not expecting to slow down. And I'm like, then employing this strategy is not going to help you next year.
Yeah, exactly.
So, and it helps you this year, it hurts you next year.
Totally. Yep, that makes sense.
Okay. When we're talking here, I kind of talk mostly about the small business owner, because I think the tax code, not because I think, but the tax code is really set up to help the small business owner. When if an individual who's listening to this is if I say strictly a W-2 wage earner, it's really hard for a strictly W-2 or what I'll call governmental form reporting taxpayer. They're getting a 1099-R, they're getting 1099 for investment income, they're getting a W-2. When your income is almost all reported to not only you by a governmental form, but also to the government, and there's nothing else, it's awfully hard to come up with creative strategies for that person. If you happen to be working at the labs and you're a PhD scientist and you just have W-2 wages, there's very little I can do. But depending upon the type of health insurance you have, if you have the opportunity to elect what's called a high deductible plan, you can contribute to a health savings account. And a health savings account is phenomenal because it does provide for you an immediate tax deduction for the dollar amount you fund. And you just need to Google HSA contribution limits for either a single individual or married couple, and there's catch-up limitations. But an HSA is phenomenal because there's no income limitations on whether or not you can contribute to an HSA. The only qualifier is you must have elected a high deductible health insurance plan. And for a lot of my small businesses, they do, because those high deductible plans have lower premiums. And you then pile on, say, you get the savings from that insurance product, but then you also get the reduction of your AGI by also contributing to an HSA. So that's a great last minute strategy as well. But it's not a last minute strategy if you didn't have a high deductible health plan. You, again, deliberately, you have to select that in order to make these HSA contributions.
And that's different than, say, an HRA, right?
Very different.
Okay.
Very different and very complex, separate conversations for a later show.
Gotcha. We talked last year about some home office deductions. Anything about that? I can't remember. I think you called it the
Augusta rule?
Yes, I knew it was one of those Roman Empire emperors. The Augusta rule. Anything sort of in that area, or feel free to steer the conversation in another direction.
Yeah, I mean, again, the Augusta rule is something that I think most people that run small businesses can take advantage of, and not to get abusive about it, but the reality is that the law allows for you as a small business owner to conduct business meetings at your home. And you can, from your business, pay yourself personally, like a rent expense. And so the business has a rent expense. And whether or not you report the income on your personal return is dependent upon how many days that you are renting it. And if you rent your personal residence for 14 days or less, that income escapes reporting, or escapes really income tax reporting. So this is a great way to take, and it's a permanent tax benefit, meaning that it's not a deferral. So it's of course it's dependent upon where you live. I'd say somebody in California, in the Napa Valley or in Beverly Hills, may pay themselves personal rents of $2,000 because that's the market rate in a very expensive zip code. But if you're living in Las Lunas, New Mexico, or Las Cruces, New Mexico, or somewhere in a rural part of Alabama where the going rate may only be $300 or $400. Again, the going rate would be, if you call the local Marriott or you call the local Hyatt and say, what would you charge me to conduct a half-day meeting at your hotel? That would be what I would use as a basis to charge myself rent. So let's not be abusive about it, be legitimate about it, and say, okay, yes, I can charge myself a day rate 12 times a year of $700 or $800 and get a business deduction and not have to report that income on my personal return. But I need to really actually conduct a business meeting at the home. So make sure you actually maintain notes. What was the agenda? When did the meeting begin? When did it end? And who attended with you? So again, if upon audit, the IRS were to ask, why were you doing this? You have records to support this expense. I'd say the real spirit of the law would be you conduct a staff meeting at your home on a monthly basis. Your staff are coming to your home. You have 4 hours of a real working meeting. You provide a lunch, some coffee, some beverages, and you're discussing marketing, you're discussing HR policies, you may be discussing budget, you may be discussing other things related to the business, but you're doing so with your office manager with your, accountant, with a handful of other people to legitimately take advantage of the law.
Okay, awesome. I guess any final thoughts before we wrap?
I'm good with that for now, Josh.